Good evening, dear members. Today we are here to learn more about assurance on related party transactions, the internal auditor roles organized by Internal Audit Standards Board. A very good evening to all of you, and it is indeed a pleasure to have learned faculty like CA Huzefa Unwala sir with us. So I welcome you to this virtual forum, sir.
Thank you, Swarupa.
Yeah. So basically, now that the audit seasons are on, all of us are busy with finalizing the books of accounts, leaving no stone unturned to see what all are the areas that as a CA, as a compliance person, we should be looking into, and something that doesn't miss out, because with greater reporting standards and more of the responsibilities pinned on us as the professionals, it is very important to know the nitty-gritties of each and every aspect involved into the transactions, and related party being one of those, which is very important, but not many of us has in-depth knowledge about its significance and how to gather the documents, make the documentation and the reporting and its consequences in case of any slip-ups. So we are really very thankful, Huzefa sir, that you accepted our request so that you can share your knowledge with us members and help us be ready for this audits. So I really thank you on behalf of all the board and the members. Now let me just have, let us just have a brief introduction of our speaker so that people do know why he is the right faculty for this particular seminar. So Huzefa Unwala sir is a founder and senior partner at JHS and Associates LLP. At JSS is currently is the lead strategy for vertical and horizontal expansions, practice growth, service innovations, and he is responsible for managing key client relationships as well. For the past 3 decades of his practice, he has worked with businesses across sectors, majorly in financial services. The industries involved in financial services and not-for-profit organizations. He has helped them strengthening their internal controls, manage risk, and enhance governance, which is very important. His work spans audit, fraud investigations, IFSC, and SOX implementations, building risk frameworks that are not just compliant, but practical and effective as well. Beyond clients' work, he's contributed in shaping professional publications through active involvement for ICAI, IIA, CIA, ISACA, and as a faculty member, author, and task force contributor at various other professional platforms as well. His career highlight as far as professional contribution is concerned, he has helped in updating ICI's financial literacy portal, PMLA guidelines, and he has authored books on audit of corporate governance practices, Regional Training Institute. He's authored the Ready Reckoner, Your Fast Track for Financial Integrity, and co-authored ERM material for the CA final examination as well. Apart from that, he's also involved in social causes and has played a different vital roles. He'd been treasurer and advisor to charities as well. So with this brief introduction, I request all of you to give sir a virtual welcome with a smile. So we welcome you to this forum, Huzefa sir. And without wasting your precious time and members' expectations from you, I now request you to please take over the session and please address our members.
Thank you, Swarupa. Thank you so much for your generous words of introduction. I hope my voice is audible and you are able to hear.
Yeah.
Great. So thank you to the Internal Audit Standards Board for inviting me yet again. It's always a pleasure to be with the IASB on discussing various topics. I have made a PowerPoint presentation which runs into about 40-50 slides. I will just start displaying it for the benefit of our audience. Here we go. I hope this is on the screen now and visible to everybody.
Yeah.
Great. So, welcome, friends, and all the participants to this discussion on internal auditors' role in assurance of related party transactions. So, the flow of the discussion today revolves around, of course, the critical part on internal auditors' role, profile, scope, criteria to be looked into as far as related party transactions are concerned, the output expected from internal audit fraternity, as well as doing some background around the concept of related party, definitions, applicability, so forth, and then also a few real life case scenarios and some controversial related party transactions that have occurred in India and picked up by the regulatory bodies, by shareholders, and the controversy surrounding that. Also, the flow of the presentation includes a small red flags metrics and risk and control metrics, which we as internal audit fraternity can follow while we are tasked with the responsibility of giving assurance on related party transactions. And we'll end with the recent SEBI industry standard forum disclosure requirements, which is one very big amendment that has happened as far as related party transactions are concerned, and we all should be much aware of the length and breadth of the quality of disclosures around related party transactions. So I'll try to cover as much as possible in the time allocated to me. So let's deep dive into the slides now. Uh, a little bit of a disclaimer that the presentation material is purely for educational purposes. It has been prepared from material available on various standards issued by the Institute of Chartered Accountants of India, by NAFRA, by IIM Bangalore, and several other leading agencies available as public content on the internet. And the views that I'm expressing are my personal views and not that of the institute as well as of my firm. So, before we delve into the conceptual framework of related party transactions, let's look at the opportunity metrics and the audit risk involved as far as related party transactions are concerned. So, interestingly, almost about 7 8 years back, the Institute of Management, IIM, Indian Institute of Management, Bangalore, did a very interesting research paper on the correlation between related party transactions and auditors' fees in India. And the green portion on the slide, the green colored font, represents the opportunity, and the red colored fonts represents the red flags and perhaps the auditor's risk as far as related party transactions are concerned. So, you have the heads and tails, two parts of the same coin, where maybe the auditors uh, are staring at a very large audit fee opportunity as far as related party transactions are concerned, as well as it's a very big regulatory focus area for obvious reasons listed down on the slide here, as well as the tendencies of Indian promoters where authority is quite concentrated at the highest level. You pick up any large company's annual report and type related party transactions, and you will find at least 20 to 30 or 40 hits on the annual report disclosures on related party transactions, because the way the law has been set in India and globally, there is a deep sense of discomfort as well as a lurking suspicion in the minds of the regulators and lawmakers that promoters tend to take out money from business enterprises through related party transactions, primarily by two sources. First is lending and loans and advances, and second is by inflation of sales and revenue. So that is the auditor's risk part, and even we as internal auditors have to safeguard ourselves against related party transactions, which is the risk element for us in terms of authorization of related party transactions, as well as appropriate and suitable disclosures as required by the law. In terms of opportunity, the paper clearly outlines that over 1,000 firms were studied, where they found that higher the related party sales and transactions, higher the audit fees of the audit firm. So it's quite natural that the scrutiny of financial statements, etc., will be more detailed and in depth where there is existence of large number of related party transactions. So this represents a big opportunity for internal audit fraternity as well. We can do a lot of third party assurance reviews on the subject of related party transactions, where boards, audit committees are now tasked with a lot of uh, expected responsibilities, not only from shareholders but from NAFRA as well, to scrutinize the related party transaction occurrences and to see whether they are legitimate, they are comprehensively reported and disclosed in the annual disclosures and filings. So essentially, it boils down to two critical matters: sales and loans, that are the red flags for auditors in India, leading to higher fees due to increased risk and effort. The IMB study underscores the need to interpret audit fee dynamics within the unique governance context of emerging economies like India. Okay, now let's look at the conceptual part of navigating related party transactions. What is a related party transaction? A related party transaction refers to any transfer of resources or services or obligations between a company and its related parties, irrespective of whether money is involved or not. If there is any transaction between two parties that can influence the decision making, then it comes within the realm of related party. So you could have the CEO's office, CFO's office, close relative of directors, associate companies, subsidiary companies, provided they have, a certain percentage of shareholding and so forth. So any nature of transaction, whether it is purchase, sales, lending, leasing, guaranteeing, such transactions will fall within the realm of related party transactions, whether or no there is any exchange of money or there is barter. Now, take example of a television channel that runs a media company that runs a television channel, and it also runs a newspaper a service. Now, say for example, if the newspaper service releases advertisements of the television channel in the newspaper, and the newspaper's advertisements are released on the television channel, and both the related parties don't charge money, but it's a barter arrangement. So still, this kind of a transaction will fall within the realm of related party transactions. So like that, that could be secondment of people, etc. So ones that are uh, on record as far as monetary exchange is concerned are easy to identify, record, report, and disclose. But ones that are in the nature of barter, it becomes little complicated. Say for example, if it's a bank and the bank has got number of subsidiaries where overdraft facilities are provided to the subsidiaries, and the bank may or may not charge on temporary overdrafts for a few hours, say 6 hours, 8 hours, 10 hours. So this also could become some kind of a non-monetary arrangement. So there could be number of such examples that could fall within the ambit of related party transactions. So identification of related party transactions and providing objective assurance is a challenge for the boards, audit committees, for the statutory auditors and regulators, and this is the opportunity for the internal auditors in terms of doing a thematic review, annual thematic review around related party transactions, and giving that uh, additional layer of confidence and comfort to the board, to the regulators, and to the shareholders. Now, importance of related party transaction disclosures. There are five buckets: enhanced transparency and accountability, mitigation of conflict of interest, building of investor confidence, heightened risk awareness, and ensuring proper appropriate regulatory compliances. So if there are good quality, high quality related party disclosures meeting the legal benchmarks and the expectations of, say, NAFRA, of ICI, various regulatory agencies, SEBI, as well as the board and audit committee, will result in all these benefit and significant benefits to the organization, avoiding any penalties. Now let's look at the conceptual framework of related party transactions as required legally in India. Again, four buckets: identification of related party transactions, necessary approvals by boards, by audit committees, by shareholders, uh, uh, and ultimately the disclosure requirements half yearly as far as listed entities are concerned, to the boards on the quarterly basis, and so forth. So here, of course, we understand the basic meaning of related party. So I'm not getting into the basic elements of the definition of related party. But in addition to that, the LODR framework of SEBI calls out deemed related party. A deemed related party is any person, entity belonging to promoter group, irrespective of their shareholding, or any person, entity holding 20% or more with effect from April 1st, 22, or 10% or more with effect from April 1st, 2023 in the listed entity, either directly or on a beneficial interest basis, at any time during the immediate preceding financial year, will fall within the definition of related party. So essentially, it is 10% or more of shareholdings. Related party transactions, already explained earlier, would come within the realm of the entire RPT universe: sale, purchase, supply of any goods or materials, selling or otherwise disposing or buying of any property, leasing of any property, availing or rendering of any services, and so forth. So, virtually the entire universe that falls within the ordinary course of business, as well as not in the ordinary course of business. If it's an ordinary course of business, as far as only unlisted entities, no need of approval if the pricing is at arm's length. But if it is not within the ordinary course of business, then definitely there is a need for approval of board, audit committees, and so forth. Now, to understand the audit risk and the risk assessment part that the internal auditors have to do, let's understand a few controversies around related party transactions, which will give us some idea and indication of what are the risk elements surrounding related party transactions. So first is a famous case of, in fact, all are quite popular and well publicized cases in the media. First is that of an airline where transactions between related parties were entered into without approvals. They were backdated. SEBI directed governance reforms around these transactions. Special purpose audits were initiated. Next is a leading manufacturing company where there was a dispute over the related party disclosure requirements, where non-disclosure of deed of family settlement was actually not disclosed. Private agreements affecting governance uh, had to be disclosed. Matter was under judicial review, and the order of SEBI stance was upheld. Then, of course, ILNFS went up to the ED, SFI level, circuitous transactions, lack of approval, circumventing RBI, and various other statutory directions. So essentially, third party, related party transactions were entered into through, circuitous transactions and diversion of money, etc. Then, in case of another leading manufacturing company, there was a case of inflated sales and profits as far as related party transactions were concerned. In another pharmaceutical case, violations around disclosure and approval norms. And in case of Power Corporation, misrepresentation of financials and breach of board authority, uh, concealment of related party transactions. So, as you can see, the past controversial related party transaction glimpses that are available of 6 cases on the slides, you'll realize that related party transactions are uh, a set of transactions that are highly abused for selfish interest of promoters, beneficial owners, etc., and resulting in into dire consequences, reputational consequences, etc. So it becomes a very high risk audit area, and thereby creating an opportunity to simplify ordinary course and arm's length, which are critical terminologies as far as related party transactions are concerned. You can look at this metrics here. Say in case of a gold dealer company, a routine monthly purchase of gold from another supplier is an ordinary course of business, yes, and it's arm's length, yes. Selling gold chains to a cousin store at cost is an ordinary course of business, yes, but it does not satisfy the arm's length criteria. Leasing out factory space to a siblings firm, whether ordinary course of business, no. Arm's length, no again. Hiring a marketing agency for Diwali campaign, ordinary course of business, yes. Arm's length, yes. Selling machinery to an unrelated buyer, not an ordinary course of business, but it's at arm's length because it's an unrelated buyer. So this just simplifies the complexity around ordinary course and arm's length. Generally, business as usual transactions well within the ambit and realm of memorandum and articles of association of a company with history of dealing with suppliers, customers, etc. Generally, those transactions are considered as ordinary course of business and and at arm's length. But where there is preferential treatment given to any related party, then it is not to be considered at arm's length pricing. Now, as far as internal auditors are concerned, let's deep dive into the role, scope, criteria, assuming that an internal auditor's office has been tasked with the responsibility of giving a third party assurance report on related party transactions. So, what would be the various areas that an internal auditor could look at as per the auditing standards, as per the SIA pronounced by the institute, and the expectations? We will also cover NAFRA's prescription on related party transactions, the Series 3 paper released by NAFRA on the expectations from the audit committee members and board members, and those expectations fall eventually on the auditors, statutory as well as internal auditors. So, what are the various buckets that an internal auditor could include in their review as far as related party transactions and universe are concerned? So first is the identification bucket of related parties and related party transactions. Second is recording of related parties and related party transactions. Third is approval of related party transactions. Fourth is accounting. And fifth is disclosure of related party transactions. In all these stages, internal auditors can play a very important and very objective role in providing assurance. So the entire risk and control metrics and the checklist as far as internal auditors is concerned can be broken down into these 5 baskets: identification, recording, approval, accounting, and disclosure. Now let's look at all of them individually. So internal auditors can play a critical role in providing assurance and confidence to shareholders, boards, audit committees, regulators, and external auditors on related party transactions. I'm reiterating, this is a very uh, critical matter because the statutory auditors generally come on a quarterly basis or once in a year basis, depending on the size and scale of the company. But internal auditors can take up regular thematics and can also review on a continuous basis any additions or deletions in the related parties or related party transaction universe. RPTs significantly impact financial reporting. Thereby, assurance on the component of related party transactions is super important. RPTs are areas of focus for regulators and shareholders. Nobody wants a surprise on these areas. So again, a good opportunity. RPTs need a neutral eye to gain credibility in the eyes of the boards, shareholders, and regulatory bodies. So internal auditors can play a vital role here. Also, quite a lot of well-governed companies have got a policy that every 2 or 3 years, independent review of related party transactions would be undertaken either by the internal auditors or by subject matter experts. So let's look at the element a little bit more in detail as far as internal auditors are concerned in auditing related party transactions at each stage of RPT. Identification of related party. So independently verify the accuracy of the list of related parties, masters, and the listing maintained by the company. Now, what happens is as far as the company is concerned, if there is any related party declaration or any related party master creation approval, there is a record and register maintained by the company. This is also validated by the company secretary's office. So the internal auditor could do a proper validation in terms of completeness of identification through internal record search, verification, as well as external records. Ensure completeness of the related parties registered and recorded with the entities. Evaluating documentation and authorization of the transactions. Review of all related party masters as well as related party transactions to ensure to see the chain of the entire documentation trail and see whether there is proper approval at each stage. Also ensure that it is at arm's length. So arm's length pricing can be ensured through a contractual review, through review of valuation reports, through benchmarking of rates, and so forth. Monitoring and reporting on related party transactions, monitoring of RPT with approvals given by the audit committee at the beginning of the year, reporting of RPTs to the audit committee, minutes, recording of the minutes, etc. Everything has to be validated, could be validated by the internal auditor's office. Disclosure of related party transactions to audit committee on a quarterly basis, to SEBI on a half yearly basis in case of a listed entity, and the annual report, the board report, and the financial statements all can be taken up by the internal auditor's office. So these are the elements that could be deep dived into. We can also look at a breakdown in subsequent slides. Now, in terms of the internal auditor's output or report to the audit committee or to the stakeholder, so it could be a agreed upon procedure review report under SRS 4400, or it could be a limited assurance report given by the internal auditor's office, or a rating report on a high, medium, low basis. So it depends on the contractual obligation of the internal auditor, the terms of reference, whether the internal auditor is internal or an external firm or a practitioner. So depending on of all of that, agreement can be reached with the audit committee on the nature and format of the report, the frequency of the reporting as far as RPTs are concerned. But essentially, what the RPT internal audit report could consider is a detailed analysis of each category of related party transactions, namely income, expenses, assets, and liabilities. In all these four buckets, there could be related party transactions. So the internal auditor could extract, summarize, analyze the related party transactions, compare it with the previous period, compare it with the budgets, compare it with the total within the income, expense, asset, and liability categories to track the movement of related party transactions, volume, as well as value of related party transactions on an overall basis, check the variance analysis on a monthly, quarterly basis, verify the underlying transactions, documents, masters, etc., and provide a reasonable assurance to the audit committee and to the board. And if there are any areas of improvement or any observations to be, any findings to be reported, the same also can be reported. Now, what could be the approach for identification of related parties? So, first is, of course, extracting the list and the register maintained by the company under the Companies Act and the LODR requirements of SEBI. Then, independently review all the directors and KMPs declarations that are provided on independence, on any new appointments, etc., so forth. Review shareholding patterns, organization structure, income tax returns of related parties, uh, compare the related party declarations provided by the directors, KMPs, review of minutes of the board of directors to check if there are any changes in disclosures made, perform independent check declarations by directors through the MCA 21 website, check regulatory status of related parties, whether they are dormant, active, striked off, etc., through external resources. So there are a number of sources through which uh, identification of related parties can be verified, can be checked independently by the internal auditor's office, and to check the completeness. Then once, of course, the entire related party universe is comprehensively mapped, then the next step is to check the documentation and authorization of the related party transactions. So here, in terms of checking the transactions, a detailed scrutiny of ledgers, a detailed scrutiny of disclosures made to the audit committee, related party transactions, along with vendor, customer, and related party names could be checked through names, pan search, etc. So a complete uh, scrutiny as far as related party transactions are concerned could be done. It can perform a full population analysis of the accounting records, even usage of audit analytical tools. AI, for that matter, could be explored in terms of writing codes to do the matching of all the transaction data with the names of the related parties, narrations, etc., everything. So a small data lake can be created and could be reviewed continuously to check the existence of related party transactions, review of underlying contracts or agreements, business rationale, valuation reports, opinions of subject matter experts, etc. Crucially important where there is a new investment made in a related party or a sale of an asset which is not generally in an ordinary course of business. So it's a extraordinary transaction. So what is the valuation? What is the underlying documentation, benchmarking of rates, etc. could be validated. Business rationale is very important. What is the purpose of the related party transaction? What is the logic for entering the related party transaction, and why there is a need to go for a related party transaction in the first place? So that can be examined, and the business rationale documentation can be evaluated, verified by the internal auditor's office to check whether it really needs to exist or not. Examine the pricing and terms of credit, the pricing, the rates, etc., whether they are at fair value, whether they are at arm's length, similar to what two unrelated parties would have entered into, comparison of transactions with historical comparisons, peer company comparisons, industry comparisons, to eliminate any conflict of interest situations. So there is a host of verification, validation, and review to be done by the internal audit transaction for the related party transactions as far as the internal auditors are concerned. So there are various limits for approvals and authorization depending on the size, nature of the related party transactions. So the internal auditors could also verify the various limits and approvals along with the limits if there are any breach of limits, whether they are adhered to, and various stakeholders have been consulted, internal reports have been created, appropriate authorization has been obtained, necessary resolutions have been passed by the board and by the audit committee. So this is a snapshot on the limits prescribed under Section 188 of the Companies Act. 10% or more of the turnover as far as sale, purchase, supply is concerned. Selling or disposing of, buying of property uh, of any kind, 10% or more of the net worth. Leasing of property of any kind, 10% or more of the turnover. Compensation 2.5 lakhs, and so forth. So all these limits have to be verified as far as related party transactions are concerned. This is a waterfall of the approval process for Companies Act as well as for LODR 2015. So in the waterfall, you will notice that where it's under the Companies Act, audit committee approvals are necessary. Board approvals are also necessary, but where it's in the ordinary course of business, and it's at arm's length, then no board approval is necessary. Also, exemptions for companies that are not listed on transactions with wholly owned subsidiary and joint venture is there. So there is an exemption there. As far as SEBI LOD is concerned, listed entity transactions, all material transactions that are 10% or more of the consolidated turnover, approval process of the members in the AGM is necessary. And where no material transactions are required, no further approval is necessary. As far as monitoring and reporting of related party transactions are concerned, minutes and records and registers maintained are crucial elements of documentation that internal auditor's office could verify to check the various approvals, compare the actual transactions entered into by the company with related parties, to check the omnibus approvals, to check for any limit breaches, quarterly review of related party transactions entered into by the company, and so forth. So from a policy perspective also, what is the related party policy and whether that is being adhered to, and appropriate disclosures as per the policy, as far also the policy whether available on the website of the company, disclosed on the website of the company, and adherence to the policy. All these points can be checked from a monitoring and reporting perspective. So this is the waterfall on the disclosures of related party transactions, again bifurcated into the Companies Act and LODR. So from a LODR perspective, there is a half yearly disclosure requirement under Regulation 23. Under the Companies Act, the disclosure is required to the board of directors, and on in the financial statements on an annual basis. As far as disclosure of interest is concerned by the directors, details of relatives by the directors, etc., all those disclosures are required to be made. Now let's dive deeper into uh, the execution landscape, assuming that we are executing a assurance assignment in the internal auditor's office to look at the related party transactions. On red flags, and then we look at a few practical scenarios and what is the expectation of NAFRA as well. So from a RCM perspective, while we are developing a risk and control RCM, of course, the standard elements around the policies, SOPs, the transaction verification, etc., all those elements will definitely come into the RCM landscape, including applications and application controls around related party transactions. But to look at the critical elements within the risk and controls, first is the evidence part. So as far as any related party transaction is concerned, what is the underlying evidence the management has maintained in writing, and whether it is duly approved or no. So, say for example, if it's a purchasing agreement with a supplier and the supplier is a related party, so whether there is a contract between the supplier and the client company, whether the contract is comprehensive and then underlying the contract, whether there are necessary invoices and so forth. So, what is the evidence of the related party and the related party transaction maintained in writing by the management and as approved? The description of the relationship also should be documented. Then, what are the related party transaction? So, what is the underlying information supporting the transaction? So, nature and proportion of the quantity. So, is there a concentration of a quantity? Say again, taking the example of a supplier contract. So, does the client company only source through the related party? Then definitely, arm's length will become a challenge and a issue if there is concentration of the proportion of the quantity that is being sourced from the related party. What is the nature of the contract? What is the pricing? What are the outstanding balances? Is there a business rationale and documented purpose? So that will justify procuring from the related party. Does the disclosure meet the requirement of the accounting standards 18 and 24? What are the outstanding balances? Is there a aging done? Amounts written off, written back during the period? What are the unconfirmed balances, if any, need to be checked and verified? From an audit trail perspective, what are the year-end transactions that are to be verified to check for any unusual matters or sudden year-end entries with the related parties are concerned? So all these elements need to be appropriately taken cognizance of and documented in the risk and control metrics or a checklist for the related party transaction review. Regulatory filings that have happened, check income tax return, check other returns and information supplied to other agencies, bank filings and confirmations in terms of uh, if there are loans and advances and there are related party transactions involved. So what are the terms, letters, guarantor relationships, documents? So say for example, if the related party is abroad operating out of India and the holding company is here and it is given a guarantee or it has given a letter of comfort, and even if it's not a subsidiary but a far off associate entity, then by virtue of giving a guarantor letter, does it become a related party transaction, may have to be evaluated. Scrutiny of investments, assets, purchase and sale, overseas investment build up, um, uh, name of shareholders, beneficial owners, independent valuation reports in terms of counter for the transactions of investments and assets have to be coming into the RCM and the checklist. Specific inquiries that we need to make as far as related parties are concerned, affiliation of directors and KMPs, especially relatives with other entities, any media comments, payment of additional fines, penalties, rates significantly above or below market rates. So rate benchmarking to check arm's length pricing is a critical component in an independent review. So either you'll have to take the rate benchmarking from the industry, from the management, or obtain independent reports from subject matter experts to satisfy your specific needs on review of related party transactions. Logic testing as part of the checklist and RCM building is very important. So in logic testing, you can look at abnormal trade terms. So if the trade term generally with suppliers or customers is 45 days, but in case of related parties it is 180 days, then it is preferential treatment. So it is abnormal trade terms, unusual pricing patterns, no specific business rationale or justification available in writing. So the related party transaction has been done by the promoter's office or the management without any proper business rationale or justification supporting the transaction may be called out by the internal auditor's office. Substance over form analysis, rushed and no approvals or adherence to the usual part. So as far as related party transactions are concerned, you have seen the waterfall. identification has to be reviewed, approvals are to be in place, proper disclosures, monitoring, everything has to be followed as per the law. But if there are related party transactions where the sequential adherence to various steps that are outlined in the legal requirements and the SOPs and the RPT policies is not adhered to, definitely it is a red flag for to be called out by the internal auditor's office. Pattern of even quantities, volumes, and values. Now, it's quite possible that where there is inflation of turnover, revenue, etc., in those arrangements, there is a routine nature of quantities that are supplied and that are built out without any specific business rationale. In such situations, because when there is a trade, genuine trade that has happened, there is always odd quantities that are ordered, dispatched basis demand and supply situation. So it's quite possible that there are pre-buy arrangements with preferred related parties to inflate turnover, where there are even quantities that are being ordered. So all these elements can be looked at from a RCM perspective while building the verification universe of related parties is concerned. As far as red flags are concerned, preferential agreements having low distribution margins and high level of discounting, unusual credit terms like general terms of 45 days and RPT, of about 180 days as a term being given out, single source procurement, inflated prices, no industry benchmarks available for pricing, failed quality test, repeated rejections, opaque ownership of related parties, pre-buy arrangements like with even quantities made, imports and exports, export and export, re-import without value addition, vice versa, payments to entities in tax havens. All these are red flags that can be analyzed, assessed by the internal auditor's office and put forth to the audit committee. Few more red flags: common contact numbers, email IDs, addresses, dormant status of related parties, uh, new parties and disclosures not found in client company records, like that you can independently find out through MCA 21 website by search of directors, relatives, or interested parties of directors, KMPs, etc. Unexplained loans and advances, no business justifications, complex maze of fund transfers, especially on the same day. So, say if the money is transferred from company A to company B, which is a related party, on the same day of receipt by company A, quite possible that there is a complex maze of fund transfers taking place because purchase and sale generally has got a pattern and is based on invoices and based on credit terms. Seldom it happens that the purchase and sale happens on the same day and fund transfer also happens on the same day. Adverse media, public searches, negative media coverage on any related party, pending litigation and regulatory actions on promoters of a related party or any related party, active legal cases reported. Again, on any related party can be called out as part of the entire review mechanism. Promoter integrity check, pattern of misconduct by promoter involving financial mismanagement, misconduct, potential repeat offenses, marked as willful defaulters, connected entities with large debt exposures, connected entities with debt defaults, significant bank guarantee invocations. These are all definitely red flags as far as related party transactions are concerned. So, staying vigilant and alert as an internal auditor to track all these events and occurrences to the extent possible through publicly available data searches, suit file cases, etc. Available on the internet. While conducting the related party reviews, internal auditors can add a lot of value to the stakeholders. Now, what are the RPT key risk indicators? Let's look at three specific KRIs from a related party transaction perspective. that could be monitored and reviewed by the internal auditor's office. First is the RPT volume and value. So tracking the number of the RPT transactions that are happening on a monthly, quarterly, semi-annual and annual basis, total value of related party transactions, identifying unusual activity and potential risks. So once you start tracking the volume and value for each related party transaction on a count and value basis, on a periodical basis, you'll get to see the trend, you'll get to see the pattern. And if there is a breach in the trend or the pattern, immediately it can be called out by the internal auditor's office. Second is identifying policy breaches. So, assessing the frequency of exceptions or breaches in policy highlights areas where controls may be weak, especially where approvals have not been taken and the policy is breached. Third is tracking disclosure delays. So, say for example, if notice of independence declarations by related parties are not on record in a timely manner, then this can become a key risk indicator and it should be monitored. So, tracking the turnaround time is also one important element as far as RPTs are concerned. So, three specific key risk indicators as far as RPTs are concerned, monitoring the volume and value to check and study the pattern and the trend and look at any deviations to the pattern and the trend. Second is identifying any policy breaches. And third is tracking disclosure delays, tracking the turnaround times. So when we do a quarterly comparison of RPTs, this is just a sample dummy data chart. So you see quarter one and you see revenue, expenditure, asset and liability related RPTs as a percentage to the total. Now you see the trend that is building up on quarter one, quarter two, quarter three, quarter four. So like that historical analysis, when you do for the volume and the value universe of RPTs, you will slowly start getting into a trend and a pattern when you compare it with the previous quarter as well as with the corresponding quarter of the previous year. And further, you can break down the chart into specifics. So how many items in revenue, how many RPT items in expenditure, in assets, in liabilities, and then you start realizing that you have a larger pattern and trend emerging on a percentage basis, and it helps you give a proper assurance to the highest level also in terms of pattern and in terms of the trend emerging on related parties. Likewise, this is the volume trending. So the slide shows you a quarterly comparison on the volume of related party transactions, whether it's going up, whether it's going down. So the count comparisons also under each category of revenue, assets, expenditure, and liability can be monitored from a RPT reporting perspective. Now let's look at few case scenarios. These are some practical case scenarios. So let's take example of royalty payment to related party. So a listed company, ABC Limited, pays brand usage slash royalty of 1,500 crores for the financial year 24-25 to its related party. How to determine whether the transactions are entered on arm's length and does it require approval of the shareholders? What are the procedures that we could verify from an internal auditor's point of view? First, that the listed entity should definitely have a agreement with ABC Limited in terms of the brand usage and the royalty payment. So there should be existence of a proper agreement with the business rationale. What are the benefits that would be derived by using the brand and payment of royalty? Then there should be an external independent agency who should provide a valuation report for the brand usage, royalty, trademark, or logo arrangements. Objective is to identify comparable publicly available agreements in the peer industry, focusing on transactions between two unrelated entities. So the subject matter expert or the independent valuer should clearly highlight any comparable transactions through publicly available data within the industry, ideally focusing on transactions that would have happened between two unrelated parties. Valuation report should be placed before the audit committee for their approval. Additionally, the agreement or contract between the listed entity and its related party for royalty or brand usage should be reviewed. So these are the three important documents that should be reviewed and commented upon by the Internal Audit Office. Based on the above procedure, the arm's length nature of the transactions could be determined. Now, as per SEBI LODR, transactions involving payments for royalty or brand usage are considered to be material if they exceed 5% of the company's annual consolidated turnover during a financial year. So, assuming that this 1,500 crores uh, exceeds or does not exceed, there would be a requirement for the shareholders' approval as per the SEBI LODR requirements. So this is one small case study around royalty and brand usage. Not necessarily that it is only for listed entity. It could be for a smaller entity as well, between the holding and subsidiary or the parent and other affiliated entities in terms of royalty and brand usage. But the principles of review from a documentation standpoint remain same. Underlying contract, subject matter experts, valuation report, and of course the internal approvals of the board, the audit committee. All these three are crucially important to make a commentary around providing reasonable assurance on the related party transaction. Let's take another practical case scenario of purchase or supply of any goods or material. A listed company, PQR Limited, entered into an agreement with its related party for purchase of product during the financial year 24-25. How to determine whether transactions are entered on arm's length basis, and does it require approval of shareholders under the Companies Act and the listing regulations. So procedures to be undertaken, the review procedures: review the agreement contract entered into by the listed entity with its related party for procurement of the product, including terms such as pricing and credit period. Review the agreement contract entered by the listed entity with the unrelated party for procurement of the same product. Now, this is quite simple because if the same product is being sourced by the company from other unrelated parties, what is the rate at which it is being procured? So that rate has to be benchmarked with the rate of the related party. If there is a differential in the rate for similar type of product, and for similar type of quantity supplied, then obviously there could be preferential treatment to related party. So therefore, it may be a breach of the policy, and it may be called out as not on arm's length basis. Compare the pricing, credit period, and other terms and conditions to assess whether the related party transaction is indeed at arm's length basis. Now, assumption one, it is on arm's length, no approval required from the shareholders. If the transaction amount is more than rupees 1,000 crores, then shareholders' approval may be required as per SEBI LODR. It is not. Second assumption, if it is not on arm's length, approval of shareholders is required under the Companies Act, provided the transaction is exceeding the limit prescribed under 188 and Rule 15 made thereunder. So that is generally 5 or 10% to make it a material transaction. So this is the second case study. Now let's move on to the NAFRA publication on RPTs. NAFRA has come out with a Series 3 discussion paper on expectations from the board and audit committees and how they should be reviewing the work of the auditor's office on related party transactions. So it's a detailed discussion paper on related parties, which I'm sure that quite a lot of you all would have already read the NAFRA publication, and it gives uh, a solid 30 to 40 point bullet points on related party transactions in terms of specific expectations. And in that also, there are few questions around whether the statutory auditor has reviewed any third party or any internal auditors report on related party transactions. So, there is a expectation from the regulators office as well as from the board and audit committee that related party transactions have to be reviewed objectively, independently by either internal auditors or by any external third party agencies to support the external and statutory auditors assurance of compliance. So it represents a good opportunity for us in the internal audit fraternity. Now, what I've done is that out of the discussion paper, I've made a small checklist with different sections, which we will quickly run through to give you a quick glimpse on what is the expected outcome of review from the board or audit committee as far as RPTs are concerned. So first is identification and completeness of related parties and related party transactions. So the boards have to clearly question and ask the auditor about the understanding of the management of the term related parties and whether the management has clearly understood the various definitions under the Companies Act, Ind AS 24, AS 18, SA 550, and SEBI LODR 2015. So the conceptual framework in the RPT policy has to be consistent with these regulatory prescriptions, and whether the management has understood and aligned the RPT policies and procedures in line with these regulatory and legal requirements in India. So that is the first part. Second is the management should make an inquiry from the auditor's office on changes from the prior period, nature of relationships within the related parties, types and purposes of related party transactions. So again, coming back to the work on the changes in the universe of related party transactions, nature of relationships between two related parties and the underlying transactions, types and purposes of related party transactions. Has the auditor considered RPT definitions under the SEBI regulations? From a controls and procedures perspective, whether a risk assessment were performed and evaluated for identification, accounting, and disclosure of RPTs, authorization of significant material RPTs, approval of transactions outside normal business. So we saw few case examples of RPTs in ordinary course of business and RPTs not in ordinary course of business. So where RPTs are of course not in ordinary course of business as required under the Companies Act, also appropriate approvals have to be sought from the board and audit committee. So what is the approval of transaction outside the normal business? So a sale and purchase generally is part of the ordinary course of business. But say if it is sale of purchase of assets, investments, and not of goods and services, it could be considered as something significant material, not in the ordinary course of business. Then what are the group structure and the legal entities around the related party transactions? Who are the beneficial holder owners? Who are the ultimate? What is the ultimate holding company? What are the legal structures surrounding the related party transactions have to be appropriately evaluated by the board, audit committee, and the auditor's office. From an internal control perspective, whether the group structure has been verified, how was the control, direct, indirect, over entities or individuals assessed, shareholders agreements and promoter confirmations. Has the management reviewed shareholder agreements to identify control relationships? Have promoters provided annual confirmations of related party entities? Are changes in promoter interest promptly notified? Do declarations include indirect holdings? So all these matters surrounding uh, ownership, surrounding the structure, surrounding declarations, changes, confirmations, etc., could be quite uh, complex and could be quite very laborious in terms of verification activities. So it could be again represent a very good opportunity for the internal auditor's office to look at all these aspects, which are the expectations of NAFRA as well. Validation and monitoring: are there procedures to independently validate promoter and director declarations? Is there a system to monitor significant investor shareholding? Connected parties and indirect transactions: has management identified connected parties and indirect RPTs? Indirect RPTs are subsidiaries, associates, subsidiaries, and so forth. Is the list of connected parties regularly updated? Technology and integration. Now, this is a super critical one. So, is the related party database maintained digitally by the organization, integrated with vendor customer master databases? This is again from a technology standpoint. The internal auditor may have to use subject matter expert to get verifications done on the ITGC side, to check the masters, to check the digital databases, etc., access controls around it, integration with the ERP or the core banking systems of these databases, and so forth. Post facto compliance is, do finance, legal, secretarial teams perform any post facto compliance checks? Now, here the hint is again towards post facto checking or historical post mortem checking, and the internal auditors could play a good role here. Have errors identified during post facto checks, and have they been rectified? Periodic confirmations: are periodic confirmations obtained from directors, promoter groups, large shareholders, other related parties? Indirect transactions: are procedures in place to identify indirect transactions benefiting related parties? Schemes of arrangements: these are not in the ordinary course of business, but certain schemes of arrangements like mergers, slum sales, uh, acquisitions, strategic deals. Have they been identified? Have they been, appropriately moving through the channels of approval, proper disclosures they made, etc. So all these elements on extraordinary transactions have to be reviewed by of course, by the board and by the auditor's office. Unidentified RPTs: did the auditor identify any RPTs not flagged by the management? Again, a critical one. If yes, were reasons for control failure investigated? Were transactions with newly identified parties evaluated? Were fraud risks assessed? So, any malafide on the management. So, the audit committee has to get into unidentified RPTs as well. Now, evaluation of RPTs: significant risks of fraud, whether evaluated as far as RPTs are concerned. Fraud risk factors identified. What procedures were performed by the auditor's office? What is the business rationale for significant RPTs? Transactions outside the normal course of business: was the rationale assessed for fraud or asset misappropriation? Were terms consistent with management's explanations? Were transactions properly accounted and disclosed? Were approvals obtained? You'll be surprised at the level of detailing that has been done on related party transactions, and even the recent amendments of SEBI on industry standard minimum requirement disclosures, or RPT, has got a very, very long checklist of almost 80 items on related party disclosures to be put up to the board, to the audit committee, to the shareholders. It's like a auditor's checklist on related party transactions, which is a very comprehensive one, and makes one believe that if that checklist is filled out, perhaps definitely there would be so much of disclosures around related party transactions that quite possibility that the auditor's risk will substantially reduce if that checklist is practiced appropriately and followed by the boards and by the audit committees. Arm's length basis evaluation: disclosure completeness. How did the auditor ensure completeness and compliance of RPT disclosures under the Companies Act, SEBI regulations, and the accounting standards? Then coming to approvals and compliance, the third component, technology and alerts. Is there a system to alert the audit committee shareholders when RPT thresholds are crossed or breached? So when the limits have been breached and approvals not sought from the board and from the audit committees and shareholders, is there a early alert mechanism available with the management? Group-wide compliance, how was the compliance ensured across listed holding company, foreign subsidiaries, entire group, contract monitoring, material modifications in the related party contractual obligations changes, any audit committee approval, shareholder approval that was warranted, exemptions, has the company availed exemptions for holding company, wholly owned subsidiaries, etc. There's a question around what procedures were performed before reporting compliance under the CARO, ratification of related party transactions post facto. What were the circumstances where ratification was done and there was no pre-approval by the audit committee? External evaluation. Was any internal external agency engaged to evaluate RPTs? This is where I was alluding to earlier on several occasions on the opportunity for the internal auditor's office to expand the scope of work to include related review of related party transactions in an objective and an independent manner, almost on a quarterly basis, where the volume of related party transactions are large. There is a specific question from NAFRA's side to the board and audit committee from an oversight question perspective, whether the external auditor has reviewed this report of an internal auditor's office or any external agency on independent evaluation of RPTs. Likewise, whether the audit committee and board has also evaluated the internal auditor's report on RPTs. Variance analysis, we saw some examples also of analysis, proposed RPT value approved by the audit committee and actual executed by the RPT. Now we will come to the last section, that is on the key amendments that have been pronounced by SEBI. This is a very big a talking point in the industry, in the corporates, listed entities, where this is considered as one of the comprehensive amendments taking shape on related party transactions, and these amendments will go a very, very long way in improving the quality of minimum disclosures to be made on related party transactions. So key amendments in RPT regulations 24-25. This is a broad rundown on the various amendments, notifications given by the regulatory authority on RPTs. So you will see that in a course of 6 to 8 months, there have been rapid amendments and changes around enhancement of materiality thresholds, industry standard circular for disclosure. Initial date was 1st April. The date was pushed to 1st September, and introduced new industry standards essentially available on the website of SOChem, FICCI, CII, etc. So it's a detailed industry effort along with the regulator's office on key amendments in RPT regulations 24-25. Uh, Now, what are the minimum information requirements? The essential information required for reporting of related party transactions, for providing approval, setting a baseline for disclosures. What are the additional information required for specific types of related party transactions, tailoring requirements to transaction nature, material RPTs, how they need to be disclosed, particularly those involving loans, investments, guarantees, borrowings, asset transfers, royalty payments, and so forth. So let's deep dive a little bit into it. So all RPTs requiring audit committee approval, material RPTs require shareholder approval. So the material RPT definition also has undergone a change as far as listed and semi controlled entities are concerned. So guidelines for placing information to the audit committee. Management must provide information in prescribed format. Mark not applicable with reasons if not applicable. Must include certificate from CEO's office, managing directors, manager, whole-time directors, plus CFO confirming related party is in the company's interest. Now, there is a certificate to be made along with the disclosure of related party transactions that it is in the company's interest. And the certificate must be made from the CEO's office, CFO's office, whole-time director's office. Necessary to attach valuation reports, subject matter external reports, if any, supporting the related party transaction. Provide financial extracts of related party if audited accounts not available. So related party audited accounts if not available, financial extracts to be provided. Each transaction type must be disclosed separately, for example, sale of goods, purchase, etc. Audit committee can record comments, seek more information, and must document reasons if rejecting the RPT. So there is a specific column provided in the minimum set of disclosures where audit committee has to give a line by line confirmation as well as commentary. So these are some huge amendments. Minimum information for all RPTs, related party details, name, country of incorporation, nature of business, relationship and ownership, direct, indirect shareholding, capital contribution, controlled relative shareholding, previous transaction history, last year financials, current year financials up to last quarter, defaults if any, transaction value, proposed value, materiality check, percentage of consolidated turnover, financial performance of related party, proposed transaction type, tenure, omnibus approval sought, value breakup if greater than 1 year, justification, director, KMP interest, valuation reports, other relevant information. So this is the part A minimum information for all related party transactions. Every related party transaction must disclose the following essential details to ensure transparency and proper oversight. So you can just fathom the comprehensiveness of disclosures of all related party transactions. So there will be a complete sea change as far as related party transactions, the disclosure is concerned for listed entities, as far as records, maintenance, as far as application systems and application changes that will undergo a change, because up till now only a simple master was being maintained where tagging of related parties for a from an identification perspective was being done. But now with the minimum information required for all RPTs, the level of disclosures that have gone that have to be made have to be maintained, recorded, and approved at various stages. Proper information systems will be required. Part B, additional information for specific RPT types. So, where it is sale, purchase of goods, services, the price basis for entering into the sales purchase contracts, the bidding process, trade advance details have to be maintained. Where it is loans, advances, deposits, source of funds, borrowing terms and interest, repayment, security purpose, where it is investment, source of funds, borrowings, purpose and terms, where it is sale, lease, disposal, bidding process and pricing, reasons and past performance, expected impact on financials, where it is borrowings, covenants and interest, cost and repayment, security and purpose, guarantees, sureties, indemnities, rational and binding nature of guarantees, covenants, recovery provisions, value of obligations, royalty payments, purpose and breakup, peer comparison, uniformity, sunset clause. So again, for all these specific RPTs, the kind of comprehensive review, disclosure, compliance, book, record keeping, etc., undergone a sea change. Additional info for material RPTs, which are the high risk RPTs, for material transactions involving loans, investment guarantees, borrowings, asset transfers, or royalty, stringent additional information is required to mitigate high risks. Credit rating of the related party, mandatory. Default history, last 3 years NPA, willful defaulter, insolvency, court proceedings, solvency and going concern status reporting, debt equity coverage ratios before and after the transaction, impact on segment reporting, intangibles, customers, etc. Royalty peer comparison and linkage to profitability. So for material high risk related party transactions, you can look at the level of disclosures, including credit ratings, default history, solvency, dormancy status, going concern status, debt equity coverage ratios, royalty peer comparison. So there will be a lot of additional work to be taken, records to be maintained, benchmarking to be done as far as material RPTs are concerned. Shareholder approval mandatory for material RPTs. Notice to shareholders to include all information placed before the audit committee, justification, pricing, and rationale, confirmation and certification from the CEO, MD, CFO certificate, disclosure of audit committee and board approval, web link and QR code for valuation and external reports. Of course, with one caveat and exemption that where a particular disclosure revolves around the commercial secrets, intellectual property rights, and certain trade secrets to be protected from competition from public need not be disclosed in the decision making process, need not be disclosed, so that can be safeguarded against. But short of that, everything else needs to be disclosed. This is the disclosure requirement checklist, material and non-material RPT. Uh, just reiterating and giving you a bird's eye view of what has been discussed in the slides before in the form of a quick checklist that is available here on your screens. So part A, part B, part C that we've already discussed. So if it is material, there is a yes, and non-material also. So part C is generally non-material. Part A, part B applies to material and non-material RPTs both. So that was the final slide from my side, and I've completed the presentation on assurance on related party transactions. With that, I will stop the slideshow. I would like to thank each one of you for the patient hearing and take up any questions and answers.
Yes, that was quite an insightful deliberation on the related party disclosures and the ways that we should be looking into to identify the already disclosed and probably few of the undisclosed transactions which might just come into the radar. So moving forward with the questions, let me just have a quick look at the questions that we have received. See, Balaji Gupta has a question. When we say transaction value exceeding 1,000 crores for shareholders' approval, how is the transaction to be treated? Like a single invoice is a separate transaction, or similar invoices grouped together is a transaction to consider the transaction value of 1,000 crores?
So it depends on the contractual agreement. So if it is, say, for example, pertaining to certain brand usage guidelines, and the total value of the contract is 1,000 crores, but broken down into various different invoices, then even if it is multiple invoices totaling to 1,000 crores, it would be treated as one single related party transaction. So it depends on the nature of contract and the arrangement.
All right. We have one more query, sir. Mr. Ramesh Subramanian. He asked if sourcing is only from the related party and hence there is no visible test of arm's length price, how do we inform audit committee if the client says that it is a proprietary product? So probably the market vigilance, what we say, we can take the value from the market. So that is also not available. In that case, how we look into the ALP part?
It's a very good question. So, and it's a big challenge for the audit fraternity. But here comes in, the subject matter experts. So we should insist on the valuation report of a subject matter expert, who's either an expert in transfer pricing or a independent expert on coming out with a benchmarking either in India or abroad in a similar industry for that similar set of transaction. So they have got specific softwares which are able to search such pricing and product mechanisms globally through use of AI and come out with a specific report or through surveys, and they certify and they give that whether it is within the arm's length or it is not within the arm's length. So management has to provide such a report to the auditor's office.
Okay, and so that means there has to be an ample disclosure about reliance on the expert opinion to arrive at the ALP.
Yes, and in case if that for any reasons is not possible, then the cost breakdown of the supplier has to be looked at. So what is the cost in building that pricing model? That has to be seen in a transparent manner, and what is the margin applied, and that can be benchmarked.
Okay, okay. So those were the questions submitted to be asked to the expert, and honestly the deliberation was quite in detail, and like every aspect, right, including the risk matrix, the checklist, everything that you have shared and discussed it point by point must have cleared all the doubts the members might be having, and their anticipation must also be fulfilled. So on behalf of the internal standards board, sir, I sincerely thank you for sharing your valuable insights and sparing your time to be here with us and guide our members. Also, I am extremely thankful to the Internal Audit Standard Board for giving me this opportunity to be a part of this webinar and be benefited from the nectar that Josefa sir shared. And thank you very much, all the members, for joining here and encouraging us to plan more and more such webinars so that members at large can also be benefited out of it. Thank you very much.
Thank you. Thank you, everybody. Thank you.